6 toxic investments destroying your wealth in 2025. Dump these now. What if I told you that some of the most popular investments in America are actually wealth destroyers disguised as opportunities? Look, 2025 is going to be a make or break year for your financial future. With inflation still lurking, interest rates shifting, and economic uncertainty everywhere, you can't afford to have your money trapped in investments designed to enrich everyone except you. The financial industry makes billions by packaging terrible investments in attractive wrapping. They use fancy names, promise safety, and target your emotions to get you buying assets that systematically destroy your wealth while making them rich. Warren Buffett once said that when management with a reputation for brilliance tackles a business with bad economics, it's the business reputation that remains intact. In this video, I'm exposing the 6 most toxic investments Americans need to dump immediately in 2025. The 6th one will blow your mind. It's something 73% of investors own, thinking it's diversification. But it's actually a wealth transfer scheme in disguise. If you want to stop being Wall Street's favorite customer and start building real wealth, hit subscribe, ring that bell, and comment, "Dump the toxic," below. Let's start with the first investment poisoning your portfolio. Toxic investment number 1, variable annuities. Here's where insurance companies have pulled off one of the greatest cons in financial history. They've convinced millions of Americans that variable annuities are safe, tax-deferred investments perfect for retirement. But these products are actually fee-laden wealth destroyers that benefit everyone except the person buying them. The fees on variable annuities are absolutely staggering. You're looking at 2 to 4% annually in total fees, management fees, mortality charges, administrative costs, rider fees, and surrender charges that can last up to a decade. A $100,000 variable annuity with 3% annual fees costs you $300,000 over 30 years, compared to a simple index fund. That's 3 times your initial investment paid in fees alone. But the psychological trap is even worse than the financial one. Insurance salespeople target retirees' deepest fears: running out of money, market crashes, leaving nothing for children. They use complex illustrations showing guaranteed income streams and downside protection, making these products seem like the responsible choice for conservative investors. Meanwhile, they're selling you the most expensive, least flexible investment possible. The surrender charges create a prison that keeps your money locked up for years. Try to get out early, and you'll pay penalties of 7 to 10% on top of tax consequences. It's like being in an abusive financial relationship where leaving costs more than staying, so people remain trapped in wealth-destroying products year after year. What makes this especially predatory is how they target older Americans who can least afford these mistakes. A 65-year-old buying a variable annuity might not live long enough to break even on the fees, yet salespeople present these as safe investments. The insurance company wins whether you live or die, while you and your family lose either way. There's an ancient Roman principle that says, caveat emptor, let the buyer beware. But with variable annuities, the complexity is deliberately designed to make awareness impossible. Roman merchants who used deceptive scales were banished from the marketplace. Today's annuity salespeople get commissions up to 10% for selling these toxic products to unsuspecting retirees. Dump variable annuities immediately if you own them, even if you have to pay surrender charges. The ongoing fees will cost you more than the exit penalty. Instead, invest in low-cost index funds and buy term life insurance separately. You'll get better returns, lower fees, and actual flexibility with your money. A retired financial advisor confessed to me, "I sold annuities for 20 years before I realized I was destroying people's retirements. The products that paid me the highest commissions were always the worst for my clients. When I finally did the math on what I'd cost people, I couldn't sleep for weeks." The insurance industry has created products so complex that even the people selling them don't understand the true costs. When professionals can't figure them out, regular investors have no chance. Toxic investment number 2, actively managed mutual funds. Here's where the mutual fund industry has been robbing investors blind for decades, while promising expertise and superior returns. Actively managed funds charge 1 to 2% annually in fees for professional management that consistently underperforms simple index funds. Yet Americans keep pouring money into these wealth destroyers because fund companies have mastered the art of selling hope and fear. The statistics are damning. Over 15 years, 92% of actively managed funds fail to beat their benchmark index. But here's the kicker. The ones that do outperform usually don't repeat their success. You're paying premium fees for performance you're statistically unlikely to receive, while the fund managers get rich whether they beat the market or not. The fee structure creates a devastating wealth transfer over time. A $100,000 investment in an actively managed fund charging 1.5% fees versus an index fund charging 0.1% costs you $140,000 over 30 years. The fund manager collects millions in fees while you struggle to build wealth. They're incentivized to take big risks with your money because they get paid regardless of the outcome. What makes this particularly toxic in 2025 is how these funds are positioned. Marketing departments spend millions creating compelling stories about market outperformance and professional management, targeting investors' desire to beat the market. They cherry-pick time periods showing good performance while ignoring the long-term underperformance that defines most active funds. The fund industry also creates artificial complexity to justify their fees. They talk about alpha generation, factor investing, and tactical allocation to make simple index investing seem inadequate. In reality, they're selling expensive solutions to problems that don't exist while creating real problems through excessive fees and poor performance. Benjamin Franklin observed a merchant who hired expensive consultants to manage his simple trading business. The consultants created elaborate strategies and charged substantial fees, but the merchant's profits decreased every year. Meanwhile, his neighbor who stuck to basic buying and selling principles grew wealthy with minimal costs. Franklin noted that complexity often masks poor value, while simplicity reveals true profit. Switch to low-cost index funds immediately. Look for total market funds with expense ratios under 0.1%. The money you save in fees will compound into hundreds of thousands in additional wealth over your investment lifetime. Stop paying for underperformance disguised as expertise. A billionaire investor once told me, "I've never met a fund manager who could consistently predict the future, but I've met plenty who could consistently collect fees. The market is smarter than any individual, so I buy the market instead of trying to beat it." The wealthy understand that paying for complexity usually means paying for inferior results. When you stop trying to outsmart the market and start owning it, your wealth grows faster and more predictably. Are you starting to see how many of these investments are actually fee collection schemes? Comment with the number 2 if you own any actively managed funds and are now questioning whether they're worth the cost. Toxic investment number 3, target date funds. This might surprise you because target date funds are marketed as the perfect set-it-and-forget-it solution for retirement planning. Fund companies have convinced employers and employees that these age-based portfolios automatically adjust risk as you approach retirement, making them ideal for 401k plans. But these funds are actually expensive, poorly designed wealth destroyers that can sabotage your retirement. The fundamental flaw is in the glide path, how the fund shifts from stocks to bonds as you age. Most target date funds become overly conservative too early, assuming you'll need income immediately at retirement, when modern retirees might live 30-plus years post-retirement. A typical 2025 target date fund might be 40% bonds for someone retiring this year, but bonds have been wealth destroyers during inflationary periods like we're experiencing now. The fee structure compounds the problem. Target date funds are essentially funds of funds, charging you management fees on top of the underlying fund fees. You might pay 0.7 to 1.2% annually for a product that's just a combination of index funds you could buy separately for 0.1 to 0.2%. Over 30 years, that extra 0.8% fee costs you $76,000 on a $100,000 investment. But the real toxicity comes from the one-size-fits-all approach that ignores individual circumstances. A wealthy investor might not need the bond allocation at all, while someone with pension income might need more growth. Target date funds treat all investors like identical widgets instead of unique individuals with different needs, timelines, and risk tolerances. The marketing around these funds is particularly deceptive. They're sold as professionally managed and automatically rebalanced, making busy employees feel like they're getting sophisticated investment management. In reality, they're getting a mediocre asset allocation with high fees that will cost them hundreds of thousands in retirement wealth. There's a Jewish teaching about a tailor who made one-size-fits-all robes for an entire village. The robes fit no one properly. They were too tight for some, too loose for others, and wrong for everyone's needs. The villagers who took the time to get properly fitted clothing looked better and felt more comfortable than those who accepted the generic solution. The lesson: mass-produced solutions rarely serve individual needs well. Build your own 3-fund portfolio instead. Total Stock Market Index, International Stock Index, and Bond Index. You can create any allocation you want, adjust it as needed, and pay a fraction of the fees. This gives you control, flexibility, and dramatically lower costs. A successful retiree shared his biggest regret: "I put everything in target date funds, thinking I was being smart and hands-off. When I finally calculated what the fees cost me and how poorly the allocation performed during inflation, I realized I'd given up $340,000 in retirement wealth for the convenience of not spending 2 hours learning about simple indexing." The lesson is that financial convenience often comes at the cost of financial success. Taking control of your investments requires minimal time, but creates massive wealth differences over decades. Toxic investment before high-dividend stock funds. Here's where income-hungry investors get trapped by what seems like conservative, safe investing. High-dividend funds promise steady income from mature companies that pay substantial dividends, appealing to retirees and conservative investors seeking yield in a low-interest environment. But these funds are often value traps that destroy wealth while creating taxable income you might not even need. The fundamental problem is that high dividends often signal business problems, not business strength. Companies with limited growth opportunities pay high dividends because they can't invest profitably in their own growth. Meanwhile, growing companies reinvest profits to build value, creating wealth through appreciation rather than income. You're essentially choosing immediate income over long-term wealth creation. The tax implications make this even more toxic. Dividends are taxed as ordinary income up to 20%, while long-term capital gains are taxed at lower rates or sometimes not at all. If you're in a high tax bracket, high dividend strategies can cost you 20 to 30% of your returns to taxes immediately, while growth investments defer taxes until you choose to realize gains. High dividend funds also suffer from sector concentration, often overweighting utilities, REITs, and mature industries that may struggle in changing economic conditions. When interest rates rise, these dividend-paying stocks often decline as investors shift to bonds offering similar yields without equity risk. You get the worst of both worlds: stock market volatility with bond-like returns. The yield chase creates dangerous behavioral patterns. Investors see a 6% dividend yield and think it's safer than a 1% yield, not realizing that high yields often reflect declining stock prices. Companies can cut dividends at any time, leaving you with both income loss and capital depreciation. It's like choosing a job based solely on the first month's pay without considering career growth potential. Marcus Aurelius wrote about citizens who demanded immediate grain distributions instead of investing in farmland that would feed them for generations. The emperor noted that those who chose immediate gratification often suffered long-term poverty, while those who invested in productive assets built lasting prosperity. The same principle applies to dividend investing versus growth investing. Focus on total return instead of yield. Buy broad market index funds that include dividend-paying stocks naturally, without overweighting them. If you need income, sell small portions of your growing investments rather than constraining yourself to high dividend assets. This gives you control over timing, taxes, and income amounts. A wealthy business owner explained his approach. "I spent years chasing dividend stocks thinking I was being conservative and smart. Then I realized I was limiting my wealth growth to pay taxes I didn't need to pay. When I switched to total return investing and created my own dividends by selling appreciated shares, my wealth grew faster and I controlled my tax situation. The irony of dividend investing is that it often produces less income over time than growth investing, while creating more immediate tax obligations. Toxic investment number 5. Cryptocurrency and meme stocks. This is where speculation disguises itself as investing, and social media replaces financial analysis. The crypto and meme stock phenomenon has created a generation of gamblers who think they're investors, pouring money into assets with no fundamental value while believing they're building wealth. These aren't investments, they're casino games with better marketing. Cryptocurrency epitomizes everything toxic about modern investing. Bitcoin and other cryptocurrencies produce no cash flow, pay no dividends, and have no intrinsic value beyond what someone else will pay for them. It's pure speculation based on the greater fool theory. You're betting someone more foolish will pay more than you did. The energy consumption alone makes Bitcoin one of the most environmentally destructive assets ever created. The meme stock phenomenon is equally destructive. GameStop, AMC, and other social media darlings become investments based on Reddit posts and TikTok videos rather than business fundamentals. Young investors pour their savings into companies losing money, thinking they're part of a movement when they're actually funding wealth transfers to early speculators and company insiders. What makes this particularly toxic is the addiction-like behavior it creates. The extreme volatility produces gambling-like dopamine hits that keep people trading rather than investing. A stock that doubles overnight creates the illusion that traditional investing is too slow, leading to increasingly risky behavior as people chase the next big score. The social media echo chambers amplify the toxicity. Platforms profit from engagement, so they promote content that generates strong emotional reactions. Loss posts and game porn create unrealistic expectations about investment returns, while confirmation bias keeps people in bubbles where their bad decisions seem validated by others making the same mistakes. The tax implications are devastating for most crypto and meme stock traders. Every trade creates a taxable event, often short-term capital gains taxed at the highest rates. People see big gains on screen, but don't realize they owe thousands in taxes, leading to tax bills they can't pay on gains that have already evaporated. There's a biblical parable about a farmer who abandoned his fields to search for buried treasure based on rumors and stories. While he dug holes looking for gold that might not exist, his neighbors who tended their crops harvested abundance year after year. The treasure hunter remained poor despite his dramatic efforts, while the farmers built steady wealth through consistent work. If you're holding crypto or meme stocks, sell them and invest in productive assets. Put that money into index funds of profitable companies that create value through products and services. You'll build more wealth with less stress and fewer tax complications. A reformed day trader shared his wake-up call. I made $80,000 day trading meme stocks in 2021 and thought I was a genius. Then I lost $120,000 trying to repeat it, plus owed $30,000 in taxes on gains I no longer had. My portfolio would be worth $200,000 more today if I'd just bought index funds instead of playing the speculation game. The market doesn't reward excitement and entertainment. It rewards patience and ownership of productive assets. What's your biggest investing mistake so far? Comment speculation trap if you've ever bought something based on social media hype rather than actual business value. Toxic investment 6. Load mutual funds and insurance investment products. Here's the most insidious wealth destroyer because it comes disguised as professional financial advice. Load funds charge you 3 to 6% upfront just to invest your money, while insurance investment products like Universal Life combine poor investment returns with expensive insurance coverage. These products exist solely to generate massive commissions for salespeople, while destroying your wealth over decades. A load fund charging 5% upfront means $5,000 of your $100,000 investment disappears immediately into someone else's pocket before your money even starts working. But the real crime is that load funds don't perform better than no-load funds. you're paying thousands extra for identical or worse performance. It's like paying a premium to enter a store that sells the same products at higher prices. Universal life insurance combines the worst of both worlds: expensive insurance with poor investment returns. The insurance component costs 5 to 10 times more than term life insurance, while the investment component typically returns 3 to 5% annually, when index funds return 10%. You're paying massive premiums for inadequate coverage and subpar investment growth. The sales tactics for these products are particularly predatory. Insurance agents and commission-based financial advisors target middle-class families, using fear and complexity to justify expensive products. They create elaborate presentations showing projected returns and tax benefits while glossing over the massive costs that make those projections impossible to achieve. What makes this especially toxic is the trust factor. These products are sold by people who call themselves financial advisors, insurance professionals, or wealth managers. Families trust these titles and assume the products must be good because a professional recommended them. Meanwhile, true fiduciary advisors avoid these products entirely because the costs are indefensible. The complexity creates a perfect smokescreen for wealth destruction. Universal life policies might have 40 pages of fine print describing costs, while load funds hide fees in prospectuses that few people read. The average investor can't calculate the true cost of these products, which is exactly how the industry designed them. King Solomon wrote about merchants who used false weights and measures to cheat customers. He observed that those who enriched themselves through deception ultimately lost their reputations and customers, while honest merchants built lasting prosperity. Today's load fund and insurance product salespeople use complexity and fear as their false weights, measuring out poor value while collecting premium prices. Avoid any investment products sold by commission-based salespeople. Work only with fee-only financial advisors who have fiduciary responsibility to act in your best interest. Buy term life insurance for protection and invest separately in low-cost index funds for growth. Never combine insurance with investing. A family who escaped these products shared their story. We paid $2,400 annually for universal life insurance that would have paid $100,000 at death, while the same $2,400 in term insurance and index funds created $340,000 in actual wealth over 20 years. The insurance salesman got rich while we almost stayed poor by trusting his advice. The lesson is that commission-based advice serves the advisor's financial interests, not yours. When someone's paycheck depends on selling you expensive products, their advice can't be trusted to serve your wealth-building goals. Now you see the 6 toxic investments that are poisoning portfolios across America in 2025. These aren't just poor choices. They're systematic wealth transfer schemes designed to enrich financial institutions while keeping you financially dependent and underinvested. Here's your action plan. Review your investments this week and identify any of these toxic products. Start with the most expensive, load funds and insurance products, then work through the rest. Every month you delay costs you money as fees compound against your future wealth. Which toxic investment hit closest to home? Comment "Portfolio Detox" and tell me which one you're dumping first. Your honesty might save someone else from making the same expensive mistakes. If this video opened your eyes to how the investment industry really works, smash that like button and share it with anyone you care about. Subscribe and hit the bell because I'm exposing more investment industry secrets throughout 2025. Next week, I'm revealing the exact portfolio allocation that made ordinary people millionaires. The simple strategy Wall Street doesn't want you to know about. Remember, the difference between building wealth and staying broke often comes down to what you don't buy, not what you do buy. Every toxic investment you avoid is money that can work for your future instead of someone else's commission check. Your wealth is too important to gamble on products designed to benefit everyone except you. Clean house, invest simply, and watch your money finally start working as hard as you do.